Well, hello everybody. This is Headley here with our Big Trends Weekly Market Outlook. The date is May 26th. The market is trying to rally back up here. We've got the S&P up to 91.16 on the SPY. That's the S&P 500 spiders, which trade about 1/10 the value of the S&P 500, meaning the S&P 500 SPX up around 911 right now. That looks like a big rally here compared to where we were late last week. But this chart to me shows me that the trend that we had in place based on my unique way of using the percent R indicator with the breakout into the overbought zone that we had back literally from late March, confirmed there on March the 26th, with a couple of nice retests that we had on March the 30th, again on April 20th at that low, and again initially held a couple weeks back at 88.50, just broke this past week on Thursday's close at 89.21 as the retest low 90.41 was violated on a close the next day. So what that means is that this rally, as we look like we're coming back to the overbought zone, means that whatever today's high is going to be a key high to watch for the week and day to day. Right now it's 91 and a quarter, but it could be higher before the end of the day. So watch that. Of course, you can see that the market has some resistance up here around the 92.5, 93 zone. That's where we stopped last time, right up not only near the upper 20-day acceleration bands in blue, but also the 80-day Bollinger Bands here in purple. And as we zoom it out, take a little bit of the bigger picture view, you can see that actually going back in time, we've actually had a couple of other periods where we ran right up into these 80-day Bollinger Bands, kind of stalled out up in that area back in April and May of last year, 2008, of course, right before a pretty big drop in the market. Now, we won't actually get bearish on the market until we get a shorter term, more oversold condition that wants to keep dropping. That's, again, the unique way I look at things at big trends for the strong trends, like what we had as we broke down back last June. You can see a very strong, steady decline. We had something similar to that, of course, more recently back here February and March, that ended right as the market bottomed there. Officially ended March 11th on that short-term nice downtrend in the market, where the spiders lost about 15% in about 3 weeks. So, right now this is a market to be cautious of. Not only does the longer-term chart also say, remember, at the end of this week is going to be the end of the month. This is really a critical point for the monthly chart. I wanted to point this out because usually we're talking about week by week, but here you can see we're coming off of that lower 80-month Bollinger Band, but the key number here is last month's high on the spider SPY, 89.02. You can see, well, as if we close the month right here at 91 and change, that would actually break and end the downtrend. It would break above that 89.02 level. That is a huge number to me to watch, and that's why I'm very suspect of this early week rally here as we're sitting here just about midway in the trading session on the first day of this new trading week, coming out of the Memorial Day long holiday weekend. So bottom line is that a lot of things can happen, and I think you're going to see a lot more volatility between now and the end of the month. It would be very encouraging for the longer term prognosis if we could go ahead and at least end this short-term percent R downtrend that's been in effect since late July of 2008 at 126.83, or back at over 1250 on the SPX. You can see it had dropped down a huge, great call there on the percent R bear trade there. As you can see, the market just completely fell out of bed last fall, as you all know by now. But bottom line is, what counts here is that what happens in this retest. Last month's high, 89.02, that's the key retest level. If we're doing the same kind of quick analysis for the bigger picture monthly outlook, I just lost my SPY here. If we go back to the SPY here, go back to the monthly chart, and we go say, okay, let's just look at that monthly chart, and you can see, okay, if we want to go switch over to the Dow, and we look at same chart template there real quick, what's our Dow number here? It is, zooming in, it is the DIA, which is the Dow Diamonds Trust, remember that trades 1/100th the value of the Dow Jones Industrial Average. Last month's high was 83.06, equivalent to about 8,306 on the Dow Jones Industrial. So right now we're just under 85, or just under 8,500 on the Dow. That tells me that, okay, we need to, it would be an exit if we finished up here, but the key is what happens on a monthly chart at the end of the month close. 83.06 on the DIA is a big number to watch. And if you're a NASDAQ follower, the QQQQ, NASDAQ 100 would be the big vehicle that we watch there. It too actually is holding, which is really bearish that the NASDAQ tends to lead the train. It's holding last month's high, 34.90, right now 34.73-ish. So basically you can see that we're 34.90 is the big number. So now you've got three key numbers to watch for the big three overall market indexes and the ETFs, the exchange traded funds that trade on those. Lastly, I'm going to finish you with the VIX outlook, the volatility index. As you likely know from reading all of our work, we follow the VIX very closely. We've been saying for a while here that 30 in general is a big number, and you can see that we had all these monthly tests above there, and more importantly on the weekly test, if you look at the weekly real quick, you can see that while %R gave a signal to say that we could head into this little downtrend, which we have had in the VIX, which has helped the market short term, it's saying, look, 30-ish as a general level here. You can see if we zoom out, it always helps to zoom out and see the big picture here. Look at what happened. We were zooming right back into the August 07 spike up to 37, closed at 29.99. Back in January of 08, ran up to 37.5, closed at 29. This is a weekly chart, mind you. Back in March of 08, hit 35.6, closed at 26. You see how important that 30 area is for the weekly closes? We had just one weekly close above there at 31.16, and it flipped right back down. Of course, when the market finally closed above 31 at 32.07 back in September 21st of last fall, the market just tanked as the VIX just went into a monster rocket to the upside. Of course, we know that that was where the VIX hit an all-time trading high, 89.53 back there in late October. Well, now we've seen this shaving of almost 2/3 of the value of the VIX, and now after fear was just roaringly high back here last fall, now fear we're scraping down to the lower Bollinger Band last week. We hit down to 26.57 as we zoom back in here. Last week it looked like it was really going to break under 30. You can see 2 weeks before we've been down to 31, but we hit 26.57 interweek, but it started to shoot up that same day to 29 and close the week out back over that key 30 level. Where are we right now? Bumping right back near 30. So while the short-term %R has said that we're in a little short-term downtrend, I'm saying be very cautious of the market here, because we're looking at a market in which 30 is a relative low point in the VIX now compared to where we used to be. We're in a different era now than where we were 2 years ago, folks, as I'm sure you all know, and the bottom line is you need to be wary of this relatively low VIX signal. Even just back to the upper 20-week Bollinger Band, that's right now just under 55. That would obviously spike to the VIX up to even 40, much less 55, would obviously cause some serious hiccups for the market on the downside. So we're playing it very cautiously here, and you should too, in our opinion.